All right, listeners, our sponsor is one of our favorite companies, Vanta, and we have something very new from them to share. Of course, you know Vanta enables companies to generate more revenue by getting their compliance certifications. That's SOC 2, ISO 27001. But the thing that we want to share now is Vanta has grown to become the best security compliance platform as you hit hypergrowth and scale into a larger enterprise.
It's kind of wild. When we first started working with Vanta and met Christina, my gosh, they had like a couple hundred customers, maybe. Now they've got 5,000, some of the largest companies out there. It's awesome.
Yeah, and they offer a tremendous amount of customization now for more complex security needs. So if you're a larger company and in the past you showed Vanta to your compliance department, you might have heard something like, oh, well, we've already got a compliance process in place and we can't integrate this new thing. But now, even if you already have a SOC 2, Vanta makes maintaining your compliance even more efficient and robust.
They launched vendor risk management. This allows your company to quickly understand the security posture of the vendors that you're choosing in a standardized way that cuts down on security review times. This is great. And then on the customization front, they now also enable custom frameworks built around your controls and policies. Of course, that's in addition to the fact that with Vanta, you don't just become compliant once, you stay compliant with real-time data pulled from all of your systems, now all of your partner systems, and you get a trust report page to prove it to your customers. If you click the link in the show notes here or go to vanta.com/acquired, you can get a free trial. And if you decide you love it, you will also get $1,000 off when you become a paying customer. Make sure you go to vanta.com/acquired.
All right, this can be a great episode.
This is going to be awesome. Yeah.
I think Administrivia might only be asking for reviews. Should we keep doing that? Does it sound needy?
Who got the truth? Is it you? Is it you? Is it you? Who got the truth now? Is it you? Is it you? Is it you? Sit me down, say it straight. Another story on the way. Who got the truth?
Welcome to episode 15 of Acquired, the podcast where we talk about technology acquisitions. I'm Ben Gilbert.
I'm David Rosenthal.
And we are your hosts. We'll be talking about the 2013 Salesforce acquisition of ExactTarget. We have with us today Scott Dorsey. Scott was the founder and CEO of ExactTarget, and I actually interned at ExactTarget for a summer when I was in college. And probably worth mentioning, Scott is also my cousin. So super, super excited to have family on the show. And welcome, Scott.
Hey, thanks, Ben. Really appreciate it. And David, delight to be on the show and proud to watch how your careers develop, Ben. And glad that you had a little stint at ExactTarget along the way. That's pretty neat.
Super, super fun. Met a lot of great people there. So
wouldn't be here today without it.
No, it's true. I think normally we talk about the acquisition history and facts, and David sort of reviews that. But I thought a really cool way of diving into the show today would be to kind of have David do a little bit of review of facts, but kind of go into a Q&A with Scott.
Yeah, that's the plan, since we're lucky enough to have the primary source here sitting with us. So for folks who don't know, ExactTarget was founded by Scott and your co-founders Chris Baggett and Peter McCormick in Indianapolis in December of 2000. So Scott, December of 2000, how did you guys decide to start a tech company? The bubble had just burst. You weren't in Silicon Valley. What was going through your minds?
Exactly, David. It's a great question, and we're a classic, kind of didn't know any better against long odds story, in that we started ExactTarget in December of 2000 under the toughest conditions. The internet bubble had burst. VC funding had really dried up, and we were three first-time software entrepreneurs, starting a tech company in Indianapolis. And actually, none of us had a technical background, so we were against long odds for sure. But we had a real clear vision around what we were trying to accomplish, and it was actually my co-founder, Chris Baggett. And while we're kind of unpacking some family stories here, Chris is actually my brother-in-law. So we both married into this great family from Indianapolis. He's from Pittsburgh and I'm from Chicago. And I had just finished my MBA at Kellogg over at Northwestern and really studied entrepreneurship and internet business models, and had just come back from our capstone course, which was studying really the Silicon Valley ecosystem and figuring out how to apply that to Chicago and how to apply that to the Midwest. And Chris had this big idea around database marketing and how to apply database marketing principles to the internet. And Chris is one of these just incredible visionaries and evangelists, and he's now done it multiple times, even post ExactTarget, by founding a company called Compendium in the blogging software space, and now he's very deep into food tech and agriculture. But Chris had a real sense that the internet was going to transform marketing, and that email marketing in particular, and permission-based email, was going to be a very powerful way for small businesses to get to know their customers better and be able to build these kind of personalized relationships and be able to deliver relevant content that drove business. And he was right. So he was so passionate about the idea that he really convinced me to kind of quit my day job. I was working for an internet incubator in Chicago called Divine, and we sold the house and had two little ones, and put the family in the car and drove to Indianapolis and said, let's give this a shot.
Wow, that's a pretty crazy. Did you guys try and raise money from Silicon Valley VCs at that point? I know. So you raised some money from friends and family and a few local individuals. Bob Compton, I believe, was your lead investor. But I got to imagine in December of 2000, not many VCs are making any investments, let alone first-time tech entrepreneurs in Indianapolis.
No, that's exactly right, David. We spun our wheels, talking to a lot of different VCs in Indianapolis, Minneapolis. We really didn't head back to the Valley in a meaningful way, but we certainly talked to a lot of VCs in the Midwest with absolutely no luck. And then started talking to angel investors who were also kind of slow to move. So our first round of financing was just a classic friends and family round. We raised about $200,000 from those that loved us and trusted us, and that early investor roster was my parents and my brother and my father-in-law, and then pretty much all of Chris's neighbors. Chris has just this infectious enthusiasm, and it's not much of an exaggeration to say he went door to door with the PPM in his neighborhood and collected $5,000 checks. And we were so careful, especially with Chris and I being family. We only wanted to raise small amounts of money from family members that if it didn't work out, there'd be no hard feelings and we wouldn't have any discomfort, around the Thanksgiving dinner table. So we scooped up a lot of $5,000 and $10,000 checks and cobbled together the first couple $100,000 in the business. And really cool story is that for those investors that put $5,000 into that seed round and went the distance, and actually a handful of them did, they held the stock all the way through the Salesforce acquisition. That $5,000 became well north of $1 million. Wow. So lots of pools and home renovation projects started popping up in Chris's neighborhood, and we had a lot of happy family members. So that was really our first move. We were a bootstrapped startup. The three of us worked without taking a salary for the first 6 months of the business, and then we were really fortunate to find Bob Compton, and Bob was a very accomplished venture capitalist and tech entrepreneur in his own right. Bob had invested in a company called Software Artistry, which was the first really Indiana software company to go public, and then later was acquired by IBM. And then he was a venture capitalist at CID Equity, and then actually ran one of their investments, Sophomore Danik, and Sophomore Danik sold to Medtronic and was a big exit. So Bob was a very accomplished investor and tech entrepreneur, and he became our lead angel investor and really became my mentor. He was chairman for the first 7 or 8 years of the business. And once Bob put money into the business, then raising capital got a lot easier. We had that stamp of credibility that we really needed.
Huh. And with only 200,000 raised, this was the era before cloud computing. How did you invest that to build the business?
It's a great question, Ben, and it's so different. AWS didn't exist, so we were buying servers. We were racking servers. We were buying networking equipment. We really had to build the infrastructure. And ironically, our first $10,000 went to Lyris, which later turned out to be an email marketing competitor. But Lyris had a server-based solution for sending email at volume, and that was one of our early licensing purchases. So really, most of the money went to building the product and building the early infrastructure. And then this was interesting. You always have to leverage your timing and your unique assets. And one of our unique assets and an element of the era was that we had a lot of awesome friends and colleagues that were looking for what was next, and a good number of them were with .coms that didn't work out, and we ended up hiring our first sales team as kind of independent contractors, where we convinced a friend that we had a big vision. This was a neat opportunity, and they would sell for us, and we gave them equity in the company, and they would sell for us, really as an independent contractor, no salary, commission only, and they had to do it all. They had to find the lead, put the pitch deck together, sell the deal, collect the deal, implement the customer, and if they made it all the way through, we paid them a commission. So we actually built this really kind of seasoned sales team early, just on the back of the fact that we had a lot of really good friends that were kind of looking for something that was next in their career. And then once we got funded, they became real employees, and we were able to provide benefits and all that good stuff. But we built a very scalable sales organization before we really could afford to.
How much do you think that sort of original DNA of totally giving all pure commission-based sales to those early sales folks, do you think kind of helped shape the way that organization was built?
Great question, Ben. A huge influence. We, from day one, were a very sales-driven, customer-driven, organization. And, just the nature of the three founders, all sales, marketing leaders, kind of general management background, everybody sold, everybody spent time with customers. And early on, we would describe ourselves as marketers building software for marketers. We had a very, very keen sense for what problem we were solving and what we wanted the product to look like and how we wanted it to function. So that was, product management, V1, was really all driven by the founders. But we created a sales culture early on where the three of us were very aggressive in selling and working with customers. And it's perhaps my very favorite element of software as a service is that if you are a good listener and you work closely with customers, they will reveal your product roadmap for you. And it's really your job to certainly bring your vision and your point of view, but you're really distilling feedback from many, many individuals and organizations, your customers and your prospects in the marketplace. And if you can distill that feedback in the right way and take action upon it, you can build an amazing solution that clients really want. So that was one of our I think one of our real strong suits was being very close to the customer and being great listeners and really helping them shape our product. But we were incredibly sales driven, and because of that kind of independent network of sales representatives that we built, we were very sales heavy early on. I look back, I did a history of ExactTarget chat a few months ago, and I looked back at one of our early decks. This was even staggering to me, but at the moment where we had 44 employees, we actually had 26 in sales.
Wow.
That's heavy. So we were very, very, very sales driven. And then we also unlocked a channel far earlier than most software companies. We realized that digital agencies could be great partners of ours. They were building websites, they were writing copy and content, but they really didn't have tools for email marketing specifically. And we built a big channel program that allowed these agencies to leverage our tech platform, rebrand it or white label it where they needed to, and build these recurring revenue streams that were advantageous for them. And that allowed us to start reaching into big, Fortune 500 companies like General Mills and Home Depot became clients of ours through their trusted agency at a time when we were still a small and scrappy company. So it helped us kind of punch way above our weight class early on. And that was a big driver of our early success.
On that front, we should say for our listeners too, this is, I think, really our first or one of our first pure enterprise technology companies that we've covered.
Ooh, actually, I'd be curious on Scott's take on saying that.
Well, but I want to come back to that because, and I say that because, as VCs, there's sort of this trope when you're looking at, investments in the enterprise that there's this matrix of, what your target customer is when you're an enterprise software company and who you sell to, and you need it's like a test. You need to have that nailed. It's are you enterprise or are you mid market or are you SMB? Do you sell direct? Do you sell via the channel? And typically you need to have very clear answers to those. But it sounds like from the get go you guys were yes to all of those. Was that deliberate? How did you think about that?
No, great question, David. We were very small business focused, very small business focused. In fact, our first wave of customers were literally restaurants, dry cleaners, pizza shops. We were very SMB and very retail oriented. And the original problem we were trying to solve was that when the retailer, turns their lights on and opens their door in the morning, they often have little visibility into who's walking in the door and who their customers are and how to build, deeper relationships. And that was part of the background that Chris brought to the business. So early on, we were, $1,000 a year subscription and very small business focused. And actually, a good number of the reasons why those early VCs said no is they just couldn't picture that this could become a large business. And then over time, through, I think being crafty and agile and very sales and customer oriented, we started to realize, actually our first wave of expansion was, to grab lots of small businesses at one time, you need to start selling to franchise organizations. So we started evolving to franchise organizations where the franchisor cared a great deal about centralized branding and content, but they wanted to give autonomy and authorship down to the franchisee. So we started to build kind of this parent-child relationship and this kind of enterprise architecture to serve franchise orgs, and that gave us a big boost. Then we started realizing that really every organization in the world is going to need to use email and digital marketing to communicate with their customers, whether you were, a nonprofit or Microsoft on the enterprise side. There really were a common set of needs. And we just built more and more sophisticated technology. And then ironically, we were a Salesforce customer from the inception of our business. So we were students of Salesforce. We really watched how Salesforce built and scaled their business. And we admired that they were, a multi-tenant SaaS platform that served small businesses all the way up to large enterprises. And I just fell in love with the idea that you could essentially build software once and sell and deploy it over and over again, and that you could build features that could be every feature we ever built. Had a switchboard. We had an on-off button where we could deploy the software and package it in a really flexible way that was very simple for the small business, or we could turn on all the advanced capabilities for the more sophisticated enterprise, and to have essentially one code base where we have clients paying $1,000 a year, and clients we had a lot of seven-figure clients and even some eight-figure clients essentially using the same platform. That's just a remarkable level of scale and flexibility. And there's a lot of tension that comes in, that applies to the organization around segmentation. Who are you building products for? How do you build your services org? What are your support models? But
these are all the things VCs are afraid of, right?
Oh yeah, absolutely. But so we started small, and then we really disrupted the incumbents by kind of inching our way up market. And I think they often underestimated us. But it was that flexibility that was strong, and I wanted to be a part of that democratization of software. I wanted to deliver compelling software to small businesses in an affordable way, and I always felt like our market opportunity would be a lot bigger if we could continue to serve SMB to enterprise. And then the really neat thing is small businesses become big businesses, and marketers leave small companies and go to big companies. So we had a lot of pull through. Actually, one of our largest customers over time was Groupon, and Groupon came into our small business inside sales team when they were barely just getting started, and they were able to scale with us, nearly every step of the way. So there are a lot of neat success stories where that SMB to enterprise range, was a big differentiator for us.
Yeah. So I'm curious. So, moving. So you have a few years of bootstrapping. You start really small. Dry cleaners, pizza shops, as you're saying, and then, things go well. A couple of years, 4 years later, 2004, you end up raising $10.5 million from Insight. By 2006, you raise another $7 million, and at that point, you're doing, sort of 40-ish million in revenue. What on that kind of stair step up, how long did it take to get to, from the individual little guys to the franchisees to up to I would assume by the time you're doing 40-ish million in revenue, you're probably already at the enterprise. They're starting to hit the enterprise at that point. Were there like specific breakpoints along the way? I'm thinking perhaps Microsoft is one of your biggest customers. How did that conversation start? How did they come into the fold?
Yeah, that's a great question, David. And maybe I'll first start with just kind of going back to that time frame. So in December of 2007, we actually filed to go public. We were 48 million. We were 48 million in revenue. We were profitable, and we were just starting to kind of reach the enterprise space. And we were extraordinarily capital efficient. So the fundraising that you reference is all accurate, but actually can be a little deceiving because each of those rounds was a mix of primary and secondary capital. So we often had a secondary component to our fundraising to provide founders, employees, and early investors an opportunity to take a little bit of money off the table along the way. And I was so grateful we did that actually because especially because of how we bootstrapped the business and how our three co-founders worked for kind of a very long period of time without paying ourselves. Having an opportunity to take a little bit of money off the table along the way was powerful because it just allowed us to sleep well at night, knowing that we had some level of financial security for our family and we'd be able to send our kids to college and all those good things. But then it got us hungry, to really want to take the business the distance and make sure we didn't prematurely sell the business. So what was interesting is when we filed in December of 2007, we had only raised $6 million in primary capital, and we had nearly as much on the balance sheet. So we had been extraordinarily capital efficient up to that point. So we filed to go public in December of 2007. The public equity market just fell apart in early 2008, and we actually stayed on file all of 2008 and ultimately decided to pull the IPO in early 2009, and that's a whole nother story I'd be happy to jump into. But I would say it was that time frame where we started reaching up into the enterprise and the nature of our business was shifting. We started building more professional services capability, and the fundamentals of the business started shifting. And in addition to the equity markets not being very favorable, it actually was a huge blessing for us because it gave us a chance to stay private, bring more capital in the business, and kind of recalibrate toward the enterprise. And it was much easier to do that as a private company.
Yeah, and that's where I wanted to go next here, kind of leading up to. So you finally go public in December of 2007, and this was the days before the Jobs Act, which hard to imagine now that, well, easy because we all lived through it, but your prospectus was out there in the public domain from December of 2007, well, still to this day, but until May of 2009, you were on file, and all your competitors could come read your S1 and see all your financials, and then you ultimately didn't go public then. I assume because of the financial crisis, and in large part, there were no IPOs happening then. What was that like?
It was so difficult. It was so difficult. You're exactly right, David.
The press, I'm sure, could read everything about you, and you're still a private company, but you have none of the benefits of being a public company, but all the downsides.
That's exactly right. I would commonly say we had all the burden and cost and pressure of being a public company with none of the benefits, zero. Because you're exactly right. This was pre-Jobs Act. And, we had to report every quarter just as if we were a public company. So the silver lining is we had a great training ground of how to set quarterly expectations, how to work with the street, how to work with analysts. We had to do quarterly, earnings calls, with the analysts that would be covering our stock. But it was very, very difficult. And a testament to the strength of our team and our company culture that we kept everybody focused. We kept everybody very positive. And 2008 was just a difficult year for running the business in general, given the economic crisis. Our churn numbers went up because a lot of our small business customers were going out of business. Renewals got tougher, upsells got tougher, new business, there was a lot of price pressure. So, we had a good year in 2008, but it was a very different year, from the prior years of our business. But it was a great learning and growth opportunity for us. And in early 2009, it became evident we were not going to get out. We certainly didn't want to. We didn't need the capital. We didn't want to go public unless we were very confident it was going to be a successful IPO. And then, to my earlier comment, the business really started shifting more to the enterprise. And I also learned a valuable lesson. We were profitable at that time, and the public markets really want to see margin expansion. And it became really evident that if we were to go public, we were going to have to show margin expansion, both gross margin and operating income. And it was going to make it very difficult for us to make the strategic investments in the business that we wanted. We were very passionate about moving beyond email into a pure digital marketing platform. We were ready for international expansion. We were ready to start a couple of our acquisitions. And all of that became a lot easier as a private company. So we pulled our IPO in early 2009 in conjunction with a large round of capital led by Battery and Scale, and then later TCV came on board as well. And our internal tagline was better than an IPO. And we really outlined for our
Well, you guys
employees.
raised, between that and then a later round you did in 2011, I think you raised more money then in the private markets than you ultimately did in your IPO.
We raised 145 million in 2009, and once again there was a large secondary component, but it gave us a war chest to really get aggressive in expanding the business, and we created a vision we called Accelerate 2013, where we became very specific around the company, what we wanted to look like in 2013. We started with the end in mind and then worked our way back, and very counterintuitive. This was the time where Sequoia sent out their favorite, kind of famous deck around, kind of the
good times.
yes, good times are over, almost mandating, 20% headcount reduction across all their portfolio companies. And as all of our competitors were pulling back, we hit the accelerator. We got very aggressive in investing in R&D development, building big sales capacity. Ultimately, we built a sales organization that was 3 or 4 times larger than our nearest competitors. So we kind of hyper invested in the business in '09 and 10, counting on the fact that when the economy came roaring back, we were going to be the best position to take advantage of it, and that happened. And then we actually rolled into our IPO, which was March of 2012, with just huge momentum. We had accelerating growth rates. We had grown in that '08 timeframe, '08, '09, around 30%, and then we moved up to the 40s, and then we were mid 50s as we kind of rolled into the public markets in early 12. So that hyper investment and that decision to stay private paid big dividends for us.
Yeah, and then talking about accelerating growth, one of the things that always struck me as really unique about ET was how deliberately you expanded the business internationally and using channel partners as the way to grow. I think we haven't really talked about international expansion at all on the show, and it'd be really interesting to kind of hear how you thought about that.
No, I'd be happy to. And you're exactly right, Ben. This was kind of a derivative of our channel and agency program, and that we knew we could get reach into markets that we likely wouldn't be able to address directly through channel partners. And we did the same thing internationally. So we found a partner in the UK, and they spun up essentially an ExactTarget reseller. And we did the same in Australia. And as those great teams and later became friends, they built their business and really scaled it around the ExactTarget platform. When they started to reach some critical mass of customers and employees, we then acquired the business. So it was kind of a low-cost, low-risk way for us to expand internationally before we would have been able to do otherwise, as kind of a small capital-efficient company. And we really validated with these partners that there was a market for our software and our services, outside the United States. And then we started working with multinationals like Nike and Expedia and Microsoft, and it became imperative if we're going to grow those relationships that we had an international presence. So 3 years in a row, we actually acquired every August. First, we acquired our reseller in the UK and used that as a beachhead to expand through Europe. And then the next August, we acquired our reseller in Australia. And then the next August, we acquired a reseller in Sao Paulo, Brazil, and gave us a great reach into that marketplace. So we did 6 acquisitions over the course of ExactTarget history, and 3 were product expansion and 3 were geo expansion.
Cool. Yeah. So you go through this period of kind of from a dead IPO that wasn't going to happen. You pull back, you raise a bunch of money at a time when nobody could raise money. You accelerate the business, come out and you go public in March of 2012, and then it's just a little over a year later that the acquisition happens. That obviously the topic of our show, we want to, and we'll get to category and tech themes and everything else in a minute. But but I want to spend a little bit of time. We were talking with Scott before the show. One of the things we love to do on Acquired is dig into these legal court cases and SEC documents and all sorts of stuff. And luckily, in ExactTarget's case, I don't think there were any major court cases, but one of the things that happens when a public company is acquired is you're required, and this will be coming out for LinkedIn soon, I can't wait to dive in, you're required to disclose to the SEC the play-by-play of exactly how the acquisition happened. And so that we'll link to it in the show notes. It's this amazing document about how the ExactTarget acquisition happened. And I'd love to just ask you to talk a little bit about that process of, how it started and again, all of it's documented publicly. Like there were 3 other bidders that we can't talk about their identities. They're referred to as Party A, Party B, and Party C in the document. But multiple offers going back and forth. I mean, that must have been such a stressful time for you. How did you navigate through it?
It was incredible. It was an incredible learning experience, and exhilarating and nerve-wracking at the same time, for sure. So we had been a public company for 5 quarters, and life was good. We had a great time. Our IPO was super successful. We came out of the New York Stock Exchange at north of $1 billion valuation, and our IPO was heavily oversubscribed, and we felt like we had all the right investors supporting us from day one. And all that learning that happened in 2008 and 2009, we're able to really apply to the S1 and filing process and IPO, and how to pick the right banks and the right analysts. And we had an amazing time going public, and really loved it. And then 5 quarters as a public company, more of the same. We kind of met and exceeded plan every quarter. We were really embraced by Wall Street and had a great investor base. We had completed 2 acquisitions, one called iGo Digital in the predictive analytics space, and a second, Pardot, in the B2B marketing automation. And life was great. We're very happy, as an independent public company, and we were growing, north of 40% year over year. Wow. What started to really happen, across the, kind of software ecosystem is that, marketing cloud solutions started really garnering more attention. And I would say really the largest, probably 5 or 6 software companies in the world, were really all shifting to the cloud and publicly stating an intent to go a lot deeper into marketing. So that started happening in a big way. And for us at ExactTarget, a big part of our strategy had been to build a very open platform, robust APIs, and lots of integrated partnerships. So our premise was that marketers need one place to store all the data they have on their customers, and then to use that data to drive more personalized and relevant communications and relationships. So even literally before the App Exchange even existed, we integrated into Salesforce, and we integrated into Microsoft Dynamics, and we had great relationships with Adobe and Omniture and kind of many others, across the industry. So it was very logical that we were attending shows and conferences and co-selling and co-marketing kind of with all these companies. But Salesforce, we've had this really rich relationship with, from being a customer to being an integrated partner to doing lots of things together in the market. And, we got to know Mark and the team. And, Salesforce had made a big push into marketing with the Radian 6 and Buddy Media acquisitions, and really, had a social first strategy. And over time, it just became apparent that their customers wanted more, that social was an important channel, but they really wanted a multi-channel platform. They wanted greater data capabilities, and they wanted a platform that was not only oriented for B2B customers, but also B2C. So we always had a close relationship with Salesforce, and would always kind of share product roadmaps and vision and direction. And it just became apparent they were going to make a bigger investment in marketing, and knocked on our door and said, hey, we'd like to collaborate and take a closer look at kind of joining forces. And you're absolutely right, David. When you're a public company and you get that kind of inbound inquiry, the level of governance and process is at a very different level.
Yeah, and I'm curious, and really for our listeners, we'll link to this document. You should read it. It's like it's like a legalese version of like high drama, of like Shakespearean drama. But did somebody hand you a playbook and be like, okay, here's what you do in this situation, or were you guys, figuring it out as you went along?
Clearly, it was a first-time experience for me, but fortunately, we had an excellent, set of advisors and board members that had quite a bit of experience, in this area, to make sure that we really followed the right process and did what was ultimately in the best interest of our shareholders. And for me, as founder and CEO, it certainly can be, kind of an emotional and even a bittersweet process. And I had hoped that the premium we were offered would be, so substantial that it was really an excellent outcome, for our shareholders and for our employees. And then I'd really hope that we ended up with an acquirer that was very strategic and would continue to invest in the business. And Salesforce became that, and a whole lot more. So the process was amazing. It was fast and exhilarating, and certainly had a lot of pressure associated with it. But I was very, very comfortable that this was the best decision for our shareholders and for our employees and all of our constituents. And now that we're able to, see what's transpired over the last 3 years, I have 100% confidence that this was a huge win for Salesforce and for ExactTarget and everybody involved with the company along the way.
Yeah, I'm really curious. You guys sold for about a 50% premium over what you had been trading at publicly. There's got to be a bunch of offers sort of coming in from investment bankers or perhaps even CEOs calling you and saying, hey, I think this might work out. What number do you start actually paying attention and listening? Like, when do you form the subcommittee?
And we should say too, the acquisition happened in June of 2013, $2.5 billion, $33.75 a share. And your IPO price, I believe, was $19 just over a year before. So,
and I think trading at 22 or so day before.
Yeah, that's about right. Our IPO price was 19. We came out at 23 and a nickel, and then largely traded in the 20s, and we're kind of in the low 20s. When Salesforce first put their first offer of $26 a share in front of us, and I'll tell you, Ben, it was less about even coming up with a number that was interesting. We were really just focused on making sure that when you get that first level of inbound interest, that we take it seriously and really handle the process in a way that's above reproach, and that we're kind of following every step you need to as a public company, and let the process run, and then ultimately let the subcommittee and the board make the best decision at the end of the process.
And it helps too. I think you guys during the negotiation process released. You beat Q1 earnings and upped guidance, and that's always a good thing to do. It's as you were saying, too, about like. When you pulled the IPO the first time, and then went out, raised all the money, then went out afterwards with the accelerating growth, great acquisitions happen when companies get bought, not sold. When you had a bright future ahead of you and things were going great and didn't need anybody, that's the...
No, that's exactly right. And you maximize value, when you are operating from a position of strength and you have multiple parties that are really interested in either making a venture investment or ultimately acquiring the company. And fortunately, we had that, we had that in a big way. And we just fit so beautifully into Salesforce. They had a big vision around the marketing cloud. We were a perfect complement to the two acquisitions they had already made. And we really brought this, data architecture that was very consumer oriented, to the table. So we give Salesforce a big entree into the B2C side of the industry. We brought this multi-channel marketing platform where by that time we'd expanded beyond email into mobile and social and web analytics. We had a really broad kind of digital multi-channel platform. We were the largest and the fastest growing marketing software company really in the world, and we were able to fill a big gap for them. And then silver lining was that we had recently acquired Pardot, and Pardot was this just gem of a company in Atlanta that we acquired for right around $100 million, and they were a B2B marketing automation player tightly integrated into Salesforce. So Salesforce not only was able to get all the benefits that ExactTarget brought to the table, but Pardot was a great snap-in that put Salesforce in a position where they could compete with Eloqua and Marketo and other players in that kind of that slice of the industry as well.
Cool.
This is a great time to tell you about one of our very favorite companies, Crusoe.
So Crusoe, as listeners know by now, is a clean compute cloud provider specifically built for AI workloads. NVIDIA is one of their major partners, and literally Crusoe's data centers are nothing but racks and racks of A100s and H100s. And because Crusoe's cloud is purpose-built for AI and run on wasted, stranded, or clean energy, they can provide significantly better performance per dollar than traditional cloud providers.
Yes, we talked about that on our ACQ2 episode with Crusoe CEO Chase Lockmiller.
The other element that makes Crusoe special is the environmental angle. Crusoe, of course, locates their data centers at stranded energy sites. So think oil flares, wind farms that can't use all the energy they generate, etc., and uses that power that would otherwise be wasted to run your AI workloads instead.
Yep. Obviously, it's a huge benefit for the environment and for customers on costs since Crusoe doesn't rely on the energy grid. Energy is the second largest cost of running AI after, of course, the price you pay NVIDIA for the chips. And these lower energy costs get passed on to customers.
It's super cool that they can put their data centers out there in these remote locations where quote unquote energy happens, as opposed to the other hyperscalers such as AWS and Google and Azure, who need to build their data centers close to major traffic hubs where the internet happens because they are doing everything in their clouds.
Yep. If you, your company, or your portfolio companies would like to use the lower cost and more performant infrastructure for your AI workloads, go to crusoecloud.com/acquired. That's CRUSOE cloud.com/acquired, or click the link in the show notes.
Well, I think it's about time we move to our next section of acquisition category. And what we'll kind of do is David and I will kind of make our picks between people, technology, product, business line, or other. And then Scott would love to get your take.
Encompassing other.
Yeah,
we picked it once or twice. But,
yeah, it's always kind of cheap when we do.
Well, I think for me, it's Scott. Obviously, your word is most important here, but clearly, this is a business line acquisition for Salesforce. Going from and it's interesting. This is going to go into my tech theme in a minute, but having been selling into the sales organization for so long and developed these huge accounts and big scale business that Salesforce had to pick up ExactTarget, and as you were mentioning, Pardot and everything else along with it, to now be able to sell into the CMO and the marketing side was clearly a business line and a great one for them.
Yeah, I mean, I've nothing to disagree with there. I mean, ExactTarget clearly had it was not just a product, but a suite of products. I think when I was finishing up my tenure there, we were launching the digital marketing hub, and that included SMS and email marketing, microsites. We had social with CoTweet, and it became clear that there was their own ExactTarget had channel to a lot of different customers that then Salesforce could expand into, but really a whole suite of products to add to Salesforce's repertoire too.
And if it weren't more clear that this is a business line, Salesforce actually still calls this the Salesforce Marketing Cloud business line that they break out into results. And Scott, you ran it when you came there, right?
Correct. I would absolutely agree, guys. There's no question that we brought a tremendous group of people and talent and culture to Salesforce, and a lot of really unique and proprietary technology. But I would agree, if you had to classify the acquisition in a new category, I would call it business line, because we just fit so beautifully into their marketing cloud strategy and brought a sizable amount of recurring revenue. We were $300 million in recurring revenue, moving to $400, and for Salesforce at their size and their growth velocity, and now you see it with Demandware, they have to make large acquisitions, that are meaningful, that actually are relevant and can contribute to that top line growth. And we were able to do that in a big way. And it's made me really proud that, Mark, on a number of occasions with Jim Cramer on Mad Money and other places, has said that ExactTarget's been the most successful acquisition that Salesforce has ever completed. And I believe that to be true. It's just gone remarkably well. And the leaders that were on my team that are now leading, kind of big functional areas within Salesforce and the Marketing Cloud, they're happy and having a tremendous amount of success and really growing the business in a big way and committing to Indianapolis, which is really, really cool. Salesforce just recently announced that in addition to the 1,400 employees they have in downtown Indy, they're going to add 800 new positions over the next few years. Wow. And then I don't know if you've heard this, Ben, but the tallest building in Indiana is the Chase Tower. Salesforce is going to consolidate and move employees into that tower, and it's actually going to be renamed the Salesforce Tower. So to have the
has a thing about towers too.
Oh yes, no, absolutely. Mark likes his towers. Mark and the team they love their towers, but it's going to be so fantastic for our tech community that the tallest building in the city and the state is actually a tech building. So it's going to be a big boost and accelerator to our tech community, which I'm very happy about.
Well, and I always remember too, there's so many unique things about ExactTarget for the region. There's this big drumbeat from, I think, maybe your first or second office that it was about being an urban company, and that people needed to, we were in Monument Circle, which was this incredibly cool, historic, center of downtown, big statue. ExactTarget had a building with this cool roof deck that looked out over it. And I remember thinking, well, I never want to work in an office park again. And I think that a lot of ExactTarget employees got super spoiled in that way.
No, that's exactly right, Ben. Our real estate strategy was was to really build around this urban core and build a campus and a work environment that was super appealing, really to the millennial, the younger generation. And it's been really fun over the last decade. Downtown Indianapolis has had this huge resurgence of housing and amazing, restaurants and kind of a lot of arts and culture and sports. And ExactTarget, has been a part of that fabric of downtown Indianapolis. And I really felt that to build, a high growth category leading company in a market like Indianapolis, we had to be in the urban core to really take advantage of just the energy, the vitality, the ability to recruit, top-notch people from all over the country. And then even to bring in, partners and VCs and customers that could fly into Indianapolis and, take a 15, 20-minute cab ride to downtown Indy and then be able to just enjoy all the benefits of that downtown setting has. And that's been neat. And I'll tell you, one of the neat legacy elements of ExactTarget is for years we've worked on getting a nonstop flight in place from Indianapolis to San Francisco, and not having it's been a real barrier. Our West Coast investors, have to jump through lots of hoops to make it into Indy for a board meeting, and it makes just fundraising for all companies here in Indy more difficult. And right around the time of the acquisition, we actually got it done with United Airlines, and have had a nonstop flight back and forth to San Francisco, which might seem trivial, but it's actually been a game changer for our tech community, and Salesforce has appreciated it as well.
No, I totally believe it. I think a lot of credence is paid to Seattle's proximity to San Francisco as a competitive advantage in fundraising and starting a company in general. And I think that kind of quick direct flight has just a tremendous amount to do with that.
It's so true. It's so true. And the same is happening at Salt Lake City. Salt Lake is this amazing tech ecosystem, with Omniture and Adobe, and now you've got, almost a dozen, I would say, kind of unicorn level valuations. And so much of that is, Salt Lake and Park City are kind of a wonderful place to be, but it's such a short hop away from Silicon Valley that you're able to raise capital and get those investors really engaged in the business.
Yeah. Moving to the next section, what would have happened otherwise is sort of two alternate futures here. And I kind of want to pose both questions to you. One is, do you think ExactTarget would have made sense with any other acquirer? And then two, ExactTarget competed against Responsys and many other companies that started as email marketing solutions for a long time. Do you think there was anyone besides ExactTarget that could have made sense at Salesforce?
I think yes to both questions. We certainly could have fit in well with a number of kind of the other largest software companies in the world that have been focused on going a lot deeper into marketing tech and saw it as a big growth area. And then there's no question, that Salesforce looked at lots of different players, over the course of time to potentially acquire. And one element that's interesting when you go through that evaluation process as a public company and really try to make the best decision for your shareholders is you really have to do a lot of financial modeling and a lot of thinking about what does life as an independent company look like. And we ultimately did come to the conclusion that being a part of Salesforce was a better outcome, higher probability outcome for our employees, for our shareholders. But there are a number of different ways that our future, could have played out. But I was very, very happy the way it played out. And I'll tell you, the other interesting dimension is a public company, we would get an enormous amount of pressure around email. When is the end of email coming, and these new channels are going to cannibalize email. Oh my gosh, it's just, it's kind of like if I had a nickel for every time I answered that question. But it was just a heavy theme, and even sometimes I'd say a cloud over our company, where we were thought of as such an email-centric company that even as we expanded around the world and expanded into all these other adjacent technologies that you referenced, Ben, we were still thought of as an email company. And I think often didn't get credit for being a broad multi-channel, omni-channel platform. But email was such a powerhouse for marketers that line of business just kept booming, and our other lines were growing, but they could never even get close, to the email side of the business, because it's just the most powerful tool that a marketer has. And as e-commerce has exploded with growth, emails become even more relevant.
Yeah. I'm curious, when you're forecasting, what does life look like as an independent company? I mean, let's say you could continue to grow 40% year over year indefinitely. Or at least to the top of some S-curve.
Easy to say on paper, hard to do in practice.
That's right. Gets tougher with the law of big numbers.
Yeah. So at what point do you, one, factor in the top of the S-curve, and then two, how many years out, what do you look at as like sort of the payback period of that premium, and say like, well, they're giving us 50% premium and we don't think that we will reach that market cap for 20 years and we're only looking at a 10-year time horizon or something like that?
Yeah, I'll tell you, that's where, that's really where the bankers and advisors and, kind of independent committee come in, because they had a lot of expertise in how to build those financial models and what time horizon, makes the most sense in order to kind of predict your independent path versus joining forces with another. So I probably can't provide a lot more detail than that, but you're exactly right, Ben. That's exactly the process that you go through. That's right.
Yeah.
I'm curious, before we move on from this, and this also bleeds into my tech theme, you don't have to say whether you considered it or not, but do you think, looking back, most of the big data-driven marketing companies of that generation, ExactTarget being one of, if not the leader, got really big, were growing really fast on a great trajectory, but then they all got swallowed up by other big enterprise companies, whether it's Oracle and Eloqua, or ExactTarget and Salesforce, or do you think there was any way that, if maybe there had been consolidation among the companies into, could there have been a giant, there's so few giant enterprise software companies, could one have been built in the marketing category?
Yeah, that's a great question. I think why it didn't happen is overlapping functionality. That when you take a look at, and there were certainly a lot of conversations that ensued along the way, could you stack together, some of these kind of large marketing tech companies to become something bigger and something more meaningful? And where it starts to run afoul or kind of collapse is that you just have a lot of duplication of functionality. So, an Omniture, got kind of pulled into Adobe early. There certainly could have been a fit between, let's say, email and digital marketing channels and analytics. That would have been a logical connection point, but they kind of got pulled into Adobe early. But when you looked at, us and Responsys and some of the B2B marketing automation companies, you often had, kind of a lot of redundant functionality. But we were headed down that path ourselves, and that's really why the Pardot acquisition made sense, and we kind of kept moving deeper into data and analytics and the web, and really trying to build out that robust platform to make all these channels work together. And what's really interesting is the big product we built that stitched it all together is a product called Journey Builder, and Salesforce has really embraced that Journey Builder platform and is applying it even across different clouds within Salesforce and using it in lots of unique ways.
Cool. David, do you have anything before we go into tech trends?
No, I don't think so. The only comment, just Scott, on what you were saying is, it's interesting. You're seeing so many startups now that are emerging, that are next generation marketing automation, but they're all taking the approach that you said of marrying it up with data and analytics. I'm thinking anything from Mixpanel and Segment as part of this ecosystem in a different way, but so many Customer.io in Portland, Intercom. It's funny, they're taking exactly the approach that you're saying, Scott.
No, it's fun. It's fun to see it evolve. One other topic that you asked me about, David, but I think I jumped into another category, but it's kind of a fun story I'd love to tell you about. It's just the nature of our Microsoft relationship. Do you mind if I just touch on that real quick?
Yeah, I would love that.
Yes, that was a really fun story. So we really became the largest cloud company running on Microsoft technology. We were early users of SQL and .NET, and really everything we built was on the Microsoft framework. And we pushed Microsoft technology, I think, to the edge, as we were building a super transactionally intensive, multi-tenant platform. But through that, we really built this wonderful relationship, and then we started integrating into Microsoft Dynamics and had a really nice relationship there. And then ultimately, Microsoft became a customer. And it's a really fun story. Microsoft had an internal email platform called Pens. That really kind of powered marketing automation and email marketing specifically for Microsoft business units. And the internal solution was not well liked across Microsoft. So when we were fortunate to land Microsoft and really go through our adoption, we built like an 18 to 24 month implementation period where we would be onboarding different business units of Microsoft onto ExactTarget and offboarding them on the internal system of pens, and we set a joint goal with the. I know, it was an acronym for I'm sure for personalized email something notification system.
You
maybe
had to beat it if you're competing against pens.
That's right. Exactly. So we actually set a goal with the Microsoft implementation team, and they were incredible to work with. That when we got to the end of the implementation and we're literally able to turn the lights off on pens, retire this internal system that was not well liked across the enterprise, that we'd have a celebration, we'd have a party, and we did. We actually on the Microsoft campus had a huge tent that was erected in an event that was just catered to the fullest. I mean, beautiful wine, beer, food, and the Microsoft team, they had to get fire marshal approval, but they actually pulled the servers that were running pens out of Microsoft data centers and brought them to the party, and we sledgehammered them. We all strapped on goggles and just beat the tar out of these servers. And
it was Office Space.
It seriously was. It was total Office Space. It was just like a spectacular way to retire their internal system. It was a blast.
Wow, that couldn't be like a better segue into what technology themes does this illustrate for you? And that's like a very physical, visceral manifestation of the one that I want to touch on, and that's businesses using software as a service to outsource anything that's not their core competency. I mean, this keeps coming up in episodes over and over again, where businesses now, with the advent of cloud computing and the general cost of starting a company going down, companies operate using tens of other companies' infrastructure and software, often even starting at a free tier or on some kind of freemium pricing structure. And it's different at that sort of scale, where they're actually migrating from something they built in-house. But I kind of wanted to open it up to you, since what you do at High Alpha is start these new software as a service companies. How do you identify where are the sort of holes where we can take something that a whole bunch of companies are doing and do it on one platform, and then they can all just pay us to use our platform?
No, it's an exciting part of High Alpha. So, High Alpha, we're a venture studio. We started a year ago, and we're a venture studio focused on starting new cloud companies. And we actually have two sides to High Alpha. High Alpha Studio is our startup studio, and we've signed up to start 8 to 10 new companies over the next 3 to 4 years. And then High Alpha Capital is our kind of second arm, and that's a venture fund that is utilized to fund our own companies when they're ready to reach scale, and then also fund other great SaaS entrepreneurs around the country. So you're right, Ben. We spent a lot of time on just ideation, looking for unmet needs, within the enterprise cloud space, and we do that through our own ideas. We do that through entrepreneurs that approach us. We spend a lot of time with corporate innovation groups and universities and just tech visionaries that have a sense for where the market's going. And this whole notion that every employer is a buyer of software is something radically different. You kind of think back to the client server days pre-cloud, and tech spending and buying was tightly controlled, tightly controlled by the CIO and the IT department. And then with the advent of cloud, it starts to kind of open up to different business unit or business line owners can make decisions within a framework. And now we're in an era where every employee is a buyer. With freemium and an employee credit card, you can spin up Slack channels and lots of other solutions, and it's creating lots of opportunity, but it's also creating quite a few unintended consequences. So you'll get a kick out of this, where you actually have started a new business. We haven't announced it yet, that essentially is a SaaS platform for managing SaaS. Managing SaaS applications. It really is, and it's targeted at the chaos and kind of the overcrowding of SaaS spend. It's a huge problem, and our MVP is about ready to go live with our first group of pilot customers. But it brings together SaaS spend, SaaS utilization, and then user sentiment, user feedback. So it brings those three variables into one platform, so organizations can, at a minimum, actually understand what they're using. What have they paid for? What's being utilized across the enterprise? What if maybe they paid for it but isn't being utilized? Where do they have overlapping products and platforms? Where's there maybe something cool happening? Like, where's there innovation happening within like one group or department that should be thought about across that organization? So that's kind of a cool company that we're excited about to help organizations kind of get their arms around how their business is using SaaS and use it in the most optimized way.
So the tech theme that I've been referencing a bunch, and this is another perfect lead in, is there's been this sort of historically in the enterprise space, which again, we haven't talked as much about on the show. There's been there kind of been sort of four-ish giants, right? Like there's Microsoft, there's SAP, there's Oracle, and then there's Salesforce, which has emerged as sort of the most recently as one of these giants. And there's this concept of like account control, and like there are lots of startups in the space, but ultimately those four companies are by far the biggest, and they have the account control with the CIOs and increasingly CMOs and heads of sales and CEOs, where they can push all sorts of products through their channel. And ExactTarget, as we talked about being a business line acquisition, was a perfect fit with Salesforce as one of their first forays into a new product, sending through their guerrilla channel, or guerrilla sized channel. Do you think that's, how do you react to that? And or one of the main theses I think of SaaS enterprise investors is that with SaaS, like that's changing, right? Like you don't, people can buy stuff freemium, like individual employees, and account control is being eroded. I don't know. How do you think about that? Being on both sides now.
I definitely see both. I definitely see both sides of it, and you're totally spot on, David. It's one of the big reasons why the ExactTarget acquisition's been successful is that Salesforce just has these amazing executive level relationships with the biggest companies around the world, and they know Salesforce, they trust them, they want to buy more products, they want to buy more products that are tightly integrated, and when you look at the Salesforce Marketing Cloud numbers, they're booming, and they're really booming because they have all those trusted CEO and CIO relationships, and then Mark and the team, they're just incredible, innovators and amazing at executing, scaling the business. So that's real. There's no question about that. However, there's still plenty of opportunity for new innovation and new entrants, and the innovator's dilemma of companies coming up with new ideas and new concepts and software that's lighter and more flexible and more mobile friendly and more consumer like. There's no shortage of room, I think, for innovation and for new companies to find their groove.
And that you don't need your CIO to approve to buy it.
You don't. That's exactly right.
Which honestly, you're talking about ideation and getting ideas for new companies and getting your first customer. Obviously, something near and dear to my heart at Pioneer Square Labs. And as someone that is often going out and transitioning from the customer development to getting your first customer and taking the people that you were talking to about what are your needs and saying, cool, we built this, will you pay for it? It's become extremely easy to do that when you have an advocate in the organization who, for, you're going to charge less than $1,000 for your product. So they just can use their credit card and you don't have to go through the CIO. So it's opened this whole new wave for us of the ability to land your first customer in a much faster time frame.
Absolutely. No, that's exactly right. And then all these great cloud platforms where you can really quickly, right, build technology, build MVPs, get it to market, and really see if you've got product market fit and you've got something that can be viable. And that's what's so fun, I think, Ben, about what we're both doing in coming up with new ideas and launching new companies is you can go from idea to MVP and proof of concept really, really quickly.
Yeah. All right, we're going to move on to what was formerly the last part of our show. I think we have a couple cool sections after, but grading the acquisition. And Scott, you can choose to participate in this or not. I feel like you might be a little bit biased, but this is obviously an incredibly successful acquisition. I mean, you hear Mark preach it to the world time and time again, and some of the biggest stages he's ever on. Obviously, a success. We've given A's to things that have like ridiculous multiples. I mean, you look at what Instagram did at Facebook, or you look at Pixar's sort of reverse integration or reverse acquisition of Disney Pictures, Disney Animation. I mean, those are our A's. So I guess where I'm going to land on this is an A- for ExactTarget.
I think I'm similar. We've talked about all the reasons why this is a great outcome. One thing that we actually didn't quote, it's funny, we're not super quantitative on this show, even though we're about acquisitions. So we went through this whole episode. We didn't talk once about your revenue, but some numbers I want to throw out. When the Exact Target in 2012, which was the final year, a full year of being a standalone company, I believe you had about 294 million in revenue, and in Salesforce's fiscal 2016, which ended January 31st, 2016. So essentially the calendar year 2015, the Marketing Cloud division did 654 million in revenue. So over twice as much in less than 3 years. So that's a pretty great outcome, I think, and speaks to the power of this. There are many product things that I'm sure that Salesforce has done with the acquisition and bolted on many things, but also just the power of these enterprise relationships that they have. So I think this was a great deal. I'm also gonna, when I think about Instagram, it went from a $1 billion acquisition price to $3 billion in revenue in like 3 years, and that's all right. I'm also a minus, but I'm on the fence here. Scott, any comments?
You guys are tough graders. You guys are really, you'd be like that professor that's really difficult, incredibly stingy about giving away an A. So life is
not fair. So
I know. I mean, Instagram is the bar. That's a high bar. Yeah, there's no question I'm biased, but I think I'd give you a really fair grade, and I definitely give a full A. No minus. I'd go with the full A, and I'll tell you the reason is that this was an extraordinary outcome. For Exact Target, you think about 3 first-time software entrepreneurs, starting a software company in Indianapolis, with very humble expectations.
Nobody thought this was going to happen, right?
Inconceivable.
You guys were the definition of underdogs.
Inconceivable that we would ultimately sell the business for $2.5 billion. And what I'm so grateful for is that every employee who was a part of Exact Target had equity in the company, and this was really a meaningful outcome for our employees. Not only just the kind of experience of a lifetime and being a part of this powerful culture we called Orange, but there was a financial outcome that was meaningful. And the neat thing is that, at $33.75 a share, every person who ever invested in Exact Target, from friends and family to venture rounds to public investors, made money. So I, smile from ear to ear just thinking about what an incredible outcome this was for everyone at Exact Target. And then the neat thing, and David, I'm glad you referenced the numbers, is that integration is remarkably difficult. It is so difficult to acquire companies, integrate them effectively. And when you look at Salesforce, this was the largest acquisition they had done, first time they'd ever acquired a public company, and to see the kind of results that have been produced, and I just know how delighted Mark and the team have been about the performance of the business. I give it an A on both sides, the Salesforce side and the Exact Target side.
As an entrepreneur, you have to love your company, right? Like if you don't, who else would?
Oh, absolutely. That's right.
Yeah. Well, let's move on to some fun we have at the end of the episode. It's a section called the Carve Out, and this is where we talk about something that's in pop culture or media that we read or watched or stumbled upon, or a product that we love. Really anything that really tickled our fancy in the last couple weeks. And I'll start with mine. I'm a big fan of The Talk Show. It is a podcast done by John Gruber of Daring Fireball that mostly covers Apple. And John does a live show every year at WWDC, the biggest Apple conference. And this year, his guests are normally friends of his or other people sort of in the Apple journalism space. And out walks, Craig Federighi and Phil Schiller, the senior VP of marketing and the senior VP of software or just engineering all up. Anyway, just like an unbelievable, candid interview with two guys that have great personalities on stage. And you normally only see these people in the extremely rehearsed, very, very perfectly timed and executed Apple keynotes. And getting them off the cuff, it's just so fun if you're a fan of Apple or just like a fan of technology and how these businesses run in general, to get that sort of candid look at these guys.
Yeah. Mine is a great book that I'm almost done reading, but been enjoying immensely. This was recommended. I saw this as a recommendation. I went to Y Combinator's startup school in 2013, I believe, either 2012 or 2013, and Jack Dorsey spoke there, and he recommended it as a book. And it's been on my list, ever since, and I just finally got around to reading it. It's a book called The Score Takes Care of Itself, and it's by Bill Walsh, who was the legendary, unfortunately late coach of the 49ers during their amazing dynasty in the 90s, and which I remember, growing up and watching, Joe Montana and Jerry Rice and Steve Young, and but the book is just, it's about his, kind of philosophy and lessons on leadership. And he's such an amazing guy. Like, he's not the, you think of like a football coach in that era, and it's like, super, hard and yelling and screaming. Like, that's not his style at all. It's just this commitment to excellence. And like, that's all that matters. And all the other stuff is just show. And, but anyway, there's lots of good gems in the book. We'll link to it in the show notes.
I'll have to check it out. That's very fun. I love the carve-out feature here, guys. This is kind of fun.
Thanks.
And David, I should clarify, Jack Dorsey is no relation. I mean, although I've got lots of family connections here on the show, Jack and I are not related to one another, although that'd be kind of fun. So my carve-out was a month ago. I was flipping channels trying to find, I think, probably an NBA playoff game, and flipped over to ESPN and caught the end of the National Spelling Bee, the Scripps National Spelling Bee. And it was phenomenal. The two finalists were an 11-year-old and a 13-year-old who were just extraordinary at their ability, obviously, to spell very difficult words and handle a tremendous amount of pressure. And they ultimately tied in the end. And this, the 13-year-old had an older sibling that had won previously, and the 11-year-old was a fifth grader who was the youngest kind of finalist and champion ever. And watching those two operate was incredible. And to me, and I'll tell you two little stories. One, it's just quite exceptional, I think, how young people are developing so quickly. And when we look across our businesses at interns or contributions new college graduates can make, they are able to contribute to businesses in a way today that never existed in the past. And watching these two kind of young students compete was really incredible. And then one of my favorite parts is that each of the finalists had to share their favorite word, which I would definitely have a difficult time spelling any of them, probably even pronouncing one of them. But one of them that stuck with me was indefatigable. And for whatever, great word, which really means tireless persistence, to be indefatigable. And as I'm working with all these early stage startups, to me, that's like the number one characteristic for a CEO or a founding team, is that they have this tireless persistence, and they have such a burning fire inside them to succeed and to solve a big problem and make a difference in the world, that you just know they're going to be successful.
That's great.
Totally agree.
David, do you want to table follow-ups until next time? We're running a little long here.
Yeah, well, maybe I'll just do one real quick, which, because we've mentioned it a few times on this show, sure. Instagram reported latest user numbers this week, or Facebook reported Instagram's latest user numbers this week. Pretty incredible. They passed 500 million registered users, 300 million daily active users. Think about that ratio. 3 out of 5 registered users on Instagram use it every single day.
Wow, that's impressive.
That's engagement.
Instagram was one of our very first shows, and like I said, it's our canonical A, but especially with Snapchat and everything going on, there's all these existential questions, and that business just continues to perform at an amazing level. So,
indeed.
Thank you, Scott.
All right, listeners, we have a longtime favorite acquired company to tell you about, Modern Treasury. Modern Treasury is the software platform that turns money movement operations into code.
Yeah, for years now, services like Stripe, Adyen, and Square have enabled developers to accept credit card payments in apps. But that's only the tip of the iceberg of what a business needs to fully handle the movement of money in and out of their company. Those payment actions from Stripe and Adyen, et cetera, flowed through to ledger systems and then reconciliations, compliance verifications, and that's before any cash actually moves between institutions, which of course involves banking operations.
Yes, their APIs, of course, work with Plaid, Stripe, Intuit, etc., but also with their incredible banking partner network with over 30 banks, meaning that for the first time, you literally can turn your banking operations at any of those institutions into software. This means faster payments, easy adoptions of new payment rails when they come out, like FedNow. It means automatic reconciliation and real-time financial data. This lets you move money at the speed of software, which, as we now know after the first half of 2023, being able to move money fast is very important.
Yes, we love Modern Treasury so much. The founders and really the whole team have become close friends of Ben and mine, really back to when they first got started. And this is a very cool full circle moment that just happened. We just emceed their first big conference here in San Francisco, Transfer, which happened at the beginning of June.
Yes, if your business involves money movement, be it a marketplace, fintech platform, real estate, lending, investing, or anyone who reconciles or moves money, go on over to moderntreasury.com/acquired and make sure that when you get in touch, you tell them that Ben and David sent you.
Yeah, hey, just to kind of close down the show, anyone listening out there, thanks so much. Tell your friends, review us on iTunes, share it on Twitter, Facebook, whatever you like to do. Snap about us if that's your thing. And Scott, how can our audience find you?
At Scott Dorsey on Twitter, and then highalpha.com. You can learn more about the new venture that we're building here in Indianapolis.
Awesome. Well, thank you so much.
Yeah, thanks so much, guys. Really enjoyed it. Thanks, Ben. Thanks, David.
Who got the truth? Is it you? Is it you? Is it you? Who got the truth now? Huh?
All right, listeners, our sponsor is one of our favorite companies, Vanta, and we have something very new from them to share. Of course, you know Vanta enables companies to generate more revenue by getting their compliance certifications. That's SOC 2, ISO 27001. But the thing that we want to share now is Vanta has grown to become the best security compliance platform as you hit hypergrowth and scale into a larger enterprise.
It's kind of wild. When we first started working with Vanta and met Christina, my gosh, they had like a couple hundred customers, maybe. Now they've got 5,000, some of the largest companies out there. It's awesome.
Yeah, and they offer a tremendous amount of customization now for more complex security needs. So if you're a larger company and in the past you showed Vanta to your compliance department, you might have heard something like, oh, well, we've already got a compliance process in place and we can't integrate this new thing. But now, even if you already have a SOC 2, Vanta makes maintaining your compliance even more efficient and robust.
They launched vendor risk management. This allows your company to quickly understand the security posture of the vendors that you're choosing in a standardized way that cuts down on security review times. This is great. And then on the customization front, they now also enable custom frameworks built around your controls and policies. Of course, that's in addition to the fact that with Vanta, you don't just become compliant once, you stay compliant with real-time data pulled from all of your systems, now all of your partner systems, and you get a trust report page to prove it to your customers. If you click the link in the show notes here or go to vanta.com/acquired, you can get a free trial. And if you decide you love it, you will also get $1,000 off when you become a paying customer. Make sure you go to vanta.com/acquired.
We'd like to thank our one listener that we see in our analytics on Zune.
And the one listener on Stitcher who happens to be my wife.
It's a great way to lead into this episode.
Who got the truth? Is it you? Is it you? Is it you? Who got the truth now? Is it you? Is it you? Is it you? Sit me down, say it straight. Another story on the way. Who got the truth?
Welcome back to episode 16 of Acquired, the podcast where we talk about technology acquisitions. I'm Ben Gilbert.
I'm David Rosenthal.
And we are your hosts. Today, we have a few notes before we dive into it. I wanted to take a minute and say a huge thank you to one of our listeners, David Resnick. He's known as the Resonator in Slack. David is an entrepreneur with a company called Bester, but in a former career, he was a recording engineer and music producer. David's been helping us tremendously with audio quality, so I wanted to give a shout out to his company. Bester is a platform to share the best things. Curate your bests into topics with automated images and links. You can use their widget with your branding embedded on your website. Find out more at bester.co. That's www.bestr.co. Which brings me to my next point. David and I were grabbing...
Big announcement alert.
Yeah. Do-do. If this were a really high production podcast, we would have
have sound effects.
That's right. We wanted to do something a little bit different with this podcast. We're at about the size where we could start doing some advertising. And actually, we'll get into our analytics a little bit later this episode as part of the topic of the show. Instead, we wanted to do something called Community Showcase. And since so many of our listeners are entrepreneurs that are building things, product people at companies or venture capitalists or finance people, really people that are involved in creating products themselves, we thought it would be really cool to try and just do a community focus every episode.
Rather than advertising, at least for now, we're going to experiment with this. We're not charging anything or making any money on this, but we really just wanted to do it as a thank you to our community and listeners, and especially those that are really engaged on the Slack channel and emailing us. So if you have something you're working on and you want us to talk about it on the show, either hit us up in the Slack community or send us an email. And
that's acquiredfm@gmail.com.
Also on our website, and we will aim to start with one and maybe do more of these every show. Let us know what you think.
Yeah, that's true. You can hit us up on Twitter too, @acquiredfm, and we may do a more kind of traditional advertising thing later, but if you're working on something, we'd love to give you a shout out on the show. So David, you ready to dive in?
I think with that, all of the preamble here is very appropriate because this episode is a meta episode about podcasts.
Yes. Today, on this episode 16, we will be covering the acquisition by Scripps of both Midroll and Stitcher. So I think we'll dive right into it. David, you want to do history and facts?
Yeah, and I should say before we do this, the theme here was first inspired by my wife Jenny. I wanted to make sure I give her a shout out. She was trying to get to our website and she was Googling acquired podcast and realized that we weren't in the top hits on SEO. So this is a unabashed SEO play to get to the top of the Google hits on for acquired podcast.
This is the first I'm hearing of this.
EW Scripps Company, for those that aren't familiar, is a very old company by technology standards, not a technology company. They are a broadcast media company, and historically it had also been a newspaper publisher, but they operate a number of cable networks and television and radio broadcasting stations locally around the country. And over the last 2 years, they've made two acquisitions that have made a huge splash in the business of podcasting space, something that Ben and I have gotten to know a little bit about over the last year. So the first company that they bought was a bootstrapped startup called Midroll. And Midroll has a super interesting history. Some of our listeners might be familiar with parts of the company. It was started in 2010 by two guys, Scott Aukerman and Jeff Ehrlich. And it was started as a company called Earwolf. It was actually a comedy podcasting network. So Scott had a podcast that was it was in LA, and he had a radio comedy show that I believe was originally called Comedy Death Ray, I think, and they eventually changed the name of it as a podcast to Comedy Bang Bang. And he had a bunch of comedians on the show, and it had a pretty loyal following. And so they decided to sort of start a podcasting network around it. So they added a bunch of other comedy shows, added culture shows and music podcasts over time. And yes, it was Comedy Death Ray that it started as. And actually, it originally, the origins of it were in the Upright Citizens Brigade, stand-up comedy in Hollywood that Scott had started doing there. And then it actually went on separate from what the company that became Midroll. Comedy Bang Bang went on to become a television show on IFC, a comedy television show. So interesting roots for what is today the giant among midgets in the podcasting world. So they bootstrapped this company. For a couple years, they were just purely a content network. And then in 2014, they were doing their own advertising for all the podcasts in the network. They were direct selling ads. And they started getting approached by advertisers who wanted to buy ad space on other podcasts that weren't part of their own network of shows that they were producing. And they kind of thought, well, that's interesting. So they launched a separate product that was an ad network, one of the first, if not the first, ad network for the podcasting industry. This was in 2014. They called it Mid-Roll Media.
That gives you a sense of how new this whole thing is. I mean, it is less than 2 years ago.
Less than 2 years ago, which is crazy given that, podcasting has been around for over 10 years, going back to the iPod.
Yeah, pretty new to an advertising-based revenue model.
Yeah.
Or really monetization at all.
Yeah, and we'll get into this in tech themes and others, but this industry, the podcasting industry, is so fragmented relative to like how many people, millions, hundreds of millions of people listen to podcasts.
Yeah.
So from the press release when they launched Midroll, they said the new company, Midroll, offers a 360-degree suite of production, distribution, and monetization services to artists, entertainers, and thought leaders. Advertisers benefit from access to the talented hosts of more than 120 shows and their engaged audiences totaling more than 15 million downloads a month using the industry's first user-focused self-service platform. So this is crazy. This is 2014, the first self-service advertising platform for the podcasting industry has 120 shows. I mean, compare that to like ad networks for display ads or other forms of advertising.
AdWords has, millions and millions of advertisers.
Millions, like this is...
Or maybe millions of sites, hundreds of thousands of probably millions of advertisers.
Yeah, this is like a grain of sand compared to like every beach on earth.
Yeah, and we'll get to the dollar amounts too, but again, a grain of sand.
But they sign up some pretty large podcasts to be part of the network. So WTF with Mark Maron, which is one of the largest podcasts out there. Barack Obama was on it recently. They have Bill Simmons' podcasts and all the Ringer podcasts. So about a year after this, and 1 year ago now, Scripps comes in and they buy the company. And it was not announced at the time how much they paid for it, but it has since come out, reported $50 million up front and another $10 million earnout to basically take out like the giant in this industry. Mm-hmm. Which pretty good return for Scott and Jeff, considering that this was totally bootstrapped. They never raised any money.
Yeah. I mean, 50 million is well, we're not going to beat around the bush. We'll get into the numbers now. Podcast advertising, there's not that much money spent right now in podcasting as a medium. According to a Wall Street Journal article from earlier this year, advertisers are only expected to spend about $35 million on podcasts this year, and that's only up about 2% from last year.
Yeah. So the whole industry, $35 million across the whole industry, of which Midroll represents many of the largest podcasts, but nowhere near the whole industry.
I don't know about nowhere near. I think it's not ridiculous to say they're the majority of the advertising spend goes through Midroll.
Of independent podcasts, probably, but the largest podcasts are probably
good point.
Like
NPR,
and
This American Life, yeah.
Gimlet.
Good point. There's a quote by the someone at Midroll saying that a handful of their podcasters gross over $1 million a year, and they have about a 30% take rate. So actually, factoring back, it looks like Midroll's annual revenue is somewhere in the neighborhood of $2 million a year.
Yeah. Wow. So Scripps acquires this company about a year ago, almost exactly a year ago. They operate it for a year. The team stays intact. The CEO, the Midroll had brought in an outside CEO, Adam Sachs. I believe he's still the CEO of the company. And then just a couple weeks ago, the other shoe drops. So one of the issues, which again we'll get into, that's been holding the podcasting industry back, again, relative to how much usage and engagement it has as a media platform with people and users out there, the amount of advertising spend in it, is all pillars of the platform are basically completely divorced from one another. So you have the way people listen to and consume the user experience, consume podcasts via clients or streaming over websites. That's completely divorced from where the podcasts are hosted, where the media is hosted, and that is also completely divorced from the advertising model.
Well, as a quick aside, why don't I give kind of what our stack and process looks like so people get a sense. And this is not unusual. I mean, these parts are swapped in and out, but they're rarely consolidated. Just to start the whole process, .fm domain names are expensive. So you're not going out and getting, a $8 GoDaddy. So you drop $100 on picking up your .fm domain name, because that's the hotness these days. So you need some way to have a consumer facing website. So we have Squarespace for that. So Squarespace generates our RSS feed and gives us a public facing site. Now, the way that we deliver podcasts over almost any client is by submitting that RSS feed to the iTunes directory. Now, iTunes doesn't host anything. They merely have a URL pointing at your RSS feed, which they scan about once a day, unless you manually force it. And then they update their directory with where your MP3s are hosted. Now we need a place to host MP3s. A lot of people use SoundCloud. A lot of people will use something like PodTrack. For a while, we were actually hosting them on Squarespace, but you don't get a lot of analytics that way. So then you need a hosting service. So we use Libsyn for that, who's actually been really great. So you pay for a hosting service to host your MP3s, which your RSS feed points.
Yeah. So now we've got just to get this podcast in the ears of you, dear listeners, we have to go through 3 companies.
Yep. So then it's in iTunes, and there's a player that ships with iOS, obviously, that or you can use iTunes on the desktop that points at the iTunes directory, but it's made available for others to point to also. So Overcast or Pocket Casts, or there is a variety of players that a lot of you are listening to, mostly on your iOS devices, over 80% on iOS devices. And again, that's completely decoupled from all the other pieces of the ecosystem. So at the end of the day, if you're advertising on a podcast, all you really know is that your name and company was mentioned in an MP3 that got shipped down to potentially an unknown number of people using an unknown number of platforms, and you don't even know if they heard it.
Yeah. And compare and contrast that to other technology-enabled media platforms like Medium for blogging, or Facebook, which we've talked about a bunch, or Twitter, or Instagram. All of those, the consumption of the content by users, the hosting of the content for content producers, and the advertising platform are all very tightly coupled into one product.
Yep. And in fact, it's the reason that those industries, the incredible measurement and the very tight coupling of all those components, are the reason why those became dominant advertising platforms. I mean, for direct response ads especially, but even brand advertising requires an amount of measurement beyond what's available in podcasting right now.
Yeah, I mean, if somebody were to come along and give Ben and me a boatload of money to read their advertisements on our show, we basically could tell them nothing about what happened with that. We actually,
is this a good time? Should we share what our numbers look like here?
Yeah. Let's do that, and then we'll pick the story back up.
Cool. So here's what we could tell them. We could tell them, I'm looking at our LinkedIn episode 2 episodes ago, that we have about 6,400 listeners, which is unique IPs that have downloaded the URL. We are non-representative. Most of the time, 60 to 70% or higher of listens are going to come through Apple's iOS player. We actually have of that. What did I say? 6,400.
Mm-hmm.
About 4,100 come from Pocket Casts, since they were kind enough to feature us on the homepage. So a lot of you are probably listening through the Pocket Casts app. About 1,000 from Apple, 297 from Marco Arment's Overcast, and then trickling on down from there through various browsers of people listening on the website. But we basically could tell them a little bit about geography. We can tell them the IP addresses and cities that people are coming from, and the clients, but we have no idea how many people actually got to that point in the episode.
Yeah. That's one of the critical pieces. We can't tell them how many of you actually heard what we would be being paid to say.
Right. And everybody, you hear those promo codes in a lot of podcasts that give you that nice 10% off. That is literally the only way that the advertiser has to attribute to that channel. So a lot of the times, you might hear an ad for Squarespace, and you go to Squarespace and you sign up, but you don't type in the code. That never ends up getting attributed to that podcast.
The loop doesn't get closed.
Nope.
And then so you get a little bit of the picture of some of the challenges with the industry. So Scripps actually, and other people have tried this before, but Scripps actually is really brilliant here. They see there's a huge arbitrage right now between the listener numbers and engagement on podcasts as a whole medium, and the complete cluster that is the state of any kind of advertising or analytics on the platform. And so the only way you can solve this is to own the full stack and bring it together.
One way to own any sort of advertising on the back end would be to be the hosting and to be the analytics, but you couldn't do the measurement unless you have the front end too. So on the web, you could run JavaScript and understand, has an ad been served? Are people clicking it? How long has it been on site? How long has it been shown? Anyway, in a podcast, you'd need to get a player that had a pretty serious market share in order to actually, understand impressions or do anything fancy around, during this part of the podcast, there's going to be something popping up. And if you want to tap that button, it'll take you directly to the site. So you don't have to remember to type it in later.
Or even just passively to know, just like on Instagram, like, did somebody actually see this picture or this ad?
Right.
So a couple weeks ago, the other shoe drops and Scripps acquires a company called Stitcher. We'd suspect many of you know about it and might be listening to us on Stitcher, but our analytics tell us there is one of you.
Thank you, Jenny.
Jenny is my wife. She loves Stitcher. So Stitcher is a podcast client for mobile devices. And it was kind of an interesting story. It was founded in 2008 by three guys, Noah Shank, Peter DeVrode, and Mike Gaffrey. And just like now, in 2008, podcasts were also experiencing a torrid growth pace. And Stitcher managed to raise quite a bit of venture money to go after this vision of creating the front door, the aggregated user experience client to become the dominant podcasting client. So they raised about $25 million over 3 rounds, first from New Atlantic Ventures, and then from Benchmark, and then from NEA. And unfortunately, it didn't work. So in 2014, about the same time that Midroll was getting launched, Stitcher actually ends up getting acquired by the French music streaming company Deezer, the sort of Spotify competitor. And that didn't work out too great either. It sort of languishes within Deezer. And then last month, Scripps bought Stitcher back from Deezer. And we don't know how much Deezer acquired it for, but we do know it was an acqui-hire, so probably not much. And so Scripps buys Stitcher for the princely sum of $4.5 million in cash.
Yeah, that's...
So this is a company that had raised $25 million as a venture-backed startup, failed, been acqui-hired by another venture-backed startup, and then now is being bought by Scripps for $4.5 million.
Yeah, and so, the strategy makes a lot of sense. All of a sudden, you're coupling the ability to really turn on the ad sales funnel with Midroll, with the ability to have a front-end client that you could instrument and do some creative things around to do advertising. At the end of the day, iOS is still the dominant platform that people listen to their podcasts on, and it ships with a podcast client. So the challenge ahead is to be able to figure out a way to make Stitcher appealing to people that they would actually go and seek out another way to listen to podcasts rather than use the built-in Apple one.
And again, like, Scripps gets this. Like, again, this is the play that you would run if you want to actually unlock the value in the podcasting ecosystem. So Adam Sisman, who's the chief digital officer at Scripps, who led the acquisition, he was quoted in the press release as basically saying just what Ben said. We certainly have the ad sales force and the connections that make us a leader in the space, but today we depend almost exclusively on distribution into other channels. This puts in place with a very strong brand, arguably with Stitcher, very strong brand, another piece of the puzzle in the ecosystem play.
Yeah, I'm just going to throw out, I don't know if it's a bias or if it's, whatever. I think Stitcher's garbage. Like, every time I open the thing, it is.
Yeah, so let's get into why Stitcher is garbage. So the tech industry, and especially the corner of the tech industry that is concerned with podcasts or have podcasts of their own, basically like erupted in an outcry when this happens. John Gruber, who hosts the talk show, which might be the largest and most influential technology podcast, he wrote a blog post saying, Midroll owning Stitcher is not good for the podcast ecosystem. Stitcher is popular, but my show is not on Stitcher because Stitcher rehosts the audio, compresses it to hell, And unless you opt out, inserts their own ads. That's not how podcasting is supposed to work. I firmly believe podcasting should be open like the web.
Yeah, so Gruber is a grumpy old man on this one. I mean, I think that there's a lot of things where I don't believe that the user experience delivered by Stitcher is very good, and I don't think the fact that they're compressing the audio is great. You want to let podcasters kind of have creative freedom on that. I think the way they currently deliver ads is kind of garbagey. The list goes on. However, is publishing worse than it was when you had to purchase your own rack-mounted web server and install your own blogging software? Like, are we in a place where if somebody creates the Blogger or Medium, or the worst case scenario on everyone's mind is the Facebook, of podcasting, is the world worse? I think there's a very valuable business to be made there, and I think you can provide potentially podcasting to more people than hear it today, because you can come up with a real sustainable business around it. There's definitely some sacrifices that would have to be made there, because I think that ultimately it would be a programmatic ad network with a full bidding system, the way that AdWords is, or the way that Facebook ads are. And, maybe that upsets a lot of people and changes the way that it works a little bit. But I think it makes podcasting a more sustainable business.
Yeah, I totally agree. I completely agree. Gruber's being a grumpy old man here. The problem isn't what Stitcher is doing. It's that they're doing a really crappy job of it. And like the parallels here, and I completely agree. I think the opportunity is huge to create, as terrified as Gruber and Ben Thompson, another one of our folks we talk about on the show are a lot. He has a blog post about this on Stratechery and talks about it on his podcast, which is excellent, Exponent, that he does with James Allworth. They're terrified of the Facebookization of podcasts. But the difference between Facebook and Stitcher is, like we talked about in the Instant Articles episode, Facebook cares a lot about the user experience and about making things beautiful. And the analogy is exact between Instant Articles, where they're taking content that publishers have created, they're self-hosting it within Facebook, and then they are serving ads that they are inserting into it, and then sharing that ad revenue with the publishers. It's the exact same dynamics. The difference is Facebook acquired Push Pop Press to do this very, very beautifully, and Stitcher is a piece of crap.
Yeah, and here, Stitcher's under new management now, so I'm very curious if Midroll strikes me as a very, very tasteful company, and Midroll might do really good things with Stitcher. I worry about it in its current state, but
the question is, there are a bunch of questions that we'll dive into. The first question is, what can Stitcher become as part of Midroll and as part of Scripps? And that's interesting, talking about in the context of our show. We've never really seen something like this, at least on our show, go successfully before, where you're acquiring a product that, again, we're hating on Stitcher here. Apologies to all of the one Stitcher fans listening to us. But, we've never really seen a product be acquired that isn't fundamentally like a good product. And then so they're sort of like betting on hope here.
LinkedIn.
Okay, well, that was a little different. Yeah. Well, but that isn't like a technology company with a great team behind it and the capability within the company to at least deliver the minimum viable product. Here it's a small subscale technology company that's part of an old school media company acquiring another vastly subscale technology company. And what they need to do is build an incredible technology-enabled user interface.
Yeah, and have we seen an example? I don't think we've done an example on the show yet where a company does... Actually, I take that back. We sort of saw it with Office. But where I was going is a company does multiple acquisitions and sort of combines them in a kind of a classic conglomerate way to build a new product from combining existing ones. And the example I'm thinking of there is with the Acompli acquisition, building Sunrise Calendar into Acompli. But we have yet to see if that is a product success or market success yet.
Yep. Well, and they were, the difference there too is like the parent company acquiring them all was Microsoft. And, you could say whatever you want about Microsoft, but they're a lot more, their technology chops are a lot better than Scripps.
Yeah, for sure.
So we're, we're obviously biased by being part of the startup ecosystem, but I'm very excited to see what entrepreneurs come up with new de novo businesses to tackle this problem.
Yeah. And so, we're talking about all the weird forces at play in podcasting right now, and kind of the weirdness of the ecosystem. There's sort of secret meetings going on with Apple and some of the bigger publishers and existing podcasters to understand, should we make this something where it's actually a monetizable platform and they own the ecosystem top to bottom. And one of the things that's sort of playing into that, why the reason everyone's making a big deal is because the cost per thousand impressions, or the CPMs, that podcasting commands, at least right now, and maybe attributable to the audience that it has, and being a very high value audience, but they have $100 CPMs. And for anyone in sort of advertising, or who has done online advertising,
it's pretty unreal.
Yeah, the average YouTube CPM in 2014 was $14. Web display ads can get anywhere from $10, $5. Podcasting is like total breakout, and that's the ceiling with $100 CPMs. And I think for this show we'd be somewhere between $25 and $50. But the people that are making their living as sort of independent podcasters right now are doing great.
They're doing great. If you have an audience and you're an independent podcaster, you can do great.
Yep. And actually, Ben Thompson makes a good case a while ago, before The Ringer started, about how Bill Simmons could move to solely podcasting, how it's much more economical, actually, if you're a writer, but you're also someone who could do a show, to write for free and publish that as your lead gen and then monetize your podcast audience.
This is a great time to tell you about one of our very favorite companies, Crusoe.
So Crusoe, as listeners know by now, is a clean compute cloud provider specifically built for AI workloads. NVIDIA is one of their major partners, and literally Crusoe's data centers are nothing but racks and racks of A100s and H100s. And because Crusoe's cloud is purpose-built for AI and run on wasted, stranded, or clean energy, they can provide significantly better performance per dollar than traditional cloud providers.
Yes, we talked about that on our ACQ2 episode with Crusoe CEO Chase Lockmiller.
The other element that makes Crusoe special is the environmental angle. Crusoe, of course, locates their data centers at stranded energy sites. So think oil flares, wind farms that can't use all the energy they generate, etc., and uses that power that would otherwise be wasted to run your AI workloads instead.
Yep. Obviously, it's a huge benefit for the environment and for customers on costs, since Crusoe doesn't rely on the energy grid. Energy is the second largest cost of running AI after, of course, the price you pay NVIDIA for the chips. And these lower energy costs get passed on to customers.
It's super cool that they can put their data centers out there in these remote locations where, quote unquote, energy happens, as opposed to the other hyperscalers such as AWS and Google and Azure, who need to build their data centers close to major traffic hubs where the internet happens because they are doing everything in their clouds.
Yep. If you, your company, or your portfolio companies would like to use the lower cost and more performant infrastructure for your AI workloads, go to crusoecloud.com/acquired. That's CRUSOE cloud.com/acquired, or click the link in the show notes.
All right, let's maybe jump into acquisition category.
Yeah.
So, I think it's pretty clear here. This is a product acquisition that is getting rolled into this suite of products.
Yep. Got to be. If they can daisy chain these things together correctly, there's a bunch of money to be made. I think it involves having exclusive content. It's hard for me to imagine a reason to go download a podcast player to play. Well, it's hard for me to imagine going and downloading Stitcher to listen to content that I could get otherwise. But if it became sort of a Netflix type thing where they're producing original content and signing exclusive artists, and maybe it doesn't quite use that model where I'm paying a subscription fee, but it does use the model where I have to be listening on the very place where I can be advertised to, then they might be able to create a real business there.
Yeah, and this is very explicitly, they've said so. This is their plan. And so Midroll was already had two pieces of the ecosystem together with the content network and the advertising network. In a news article, in an interview after the acquisition of Stitcher, this kind of came that Midroll has just come out with a new premium service called Howl, which offers original shows and ad-free archives of popular podcasts. So they're clearly moving into this kind of Netflix type category. And they interviewed the president of the VP of Business Development at Midroll, Eric dying, and they say, and he says clearly at some point the two will intersect.
Yeah. Okay, moving on to, do you want to do what would have happened otherwise?
Yeah, I mean, I think in this case, like, this is sort of the first real splash that's been made of somebody trying to do the obvious and bring the three pillars of this medium together. So I think otherwise, like, we would just continue to drift.
Yeah, Stitcher continues to languish, Midroll continues to grow incrementally and is able to sell to, sell ads to some of the big but not network big podcasts. And we continue to see a lack of consolidation and no money go to podcasting.
Yep. And what's interesting this is almost the, like, not what would have happened otherwise, but what will happen now. I do wonder if this is like the shot across the bow that wakes up some folks in the entrepreneurial and startup community to realize, man, there's a big opportunity here, and build or attempt to build, what Stitcher tried to in the beginning.
Yeah, David, it feels like you're teeing me up a little bit. We actually gave this a go at Pioneer Square Labs, and we were really interested in podcasting just based on the growth trajectory of the amount of people that have started listening to podcasts in the last couple of years. It's still not a huge number of people, but the growth rate's really good. And one of the reasons, for all the reasons on this show that we've already talked about, we shied away from it, where, there's only, $30 to $40 million spent a year on it. You can't really stick your toe out with an MVP. You have to be the hosting, the analytics. You really have to have a client out there, and your client has to have some reason to be better than Apple's client, because, shipping with the platform is a huge advantage. There was one thing that we really wanted to do, and that was dynamic ad insertion so that we could sell ads programmatically. And one thing that we felt was super important was for the host to be able to read the ads, because that's been one of the things that commands the really high CPMs in the world today. And one way that we were going to do that is have the host go through and record ahead of time the ad reads, and then we could insert in the host's own voice anywhere throughout the audio.
Oh, that's cool.
The ads. So we started, looking at this, and we started figuring out, okay, cool, we can make like pretend MP3 URLs and dynamically generate those episodes with the appropriate ad for that person at the moment that it gets downloaded by their podcast client and send it specifically to them. We started looking around. There really are some people tackling this right now. There's a company called Acast that's doing dynamic ad insertion. And actually just recently, Panoply launched a company called Megaphone, or I guess a product called Megaphone.fm, and they also are doing the dynamic ad insertion. They've got this cool UI where if you're an advertiser or a host, you can go in and select the spots where you want to insert the ads. So, some people are making runs at this. I continue to think that you need to be able to show real measurement from the client side, but who knows? Maybe something crazy will change, and Apple will have an API to plug into for that. They're suddenly not averse to
services revenue.
Well, yeah, and an advertising model, as we're seeing with changes in the App Store. And if they can find a way that continues to ensure user privacy but makes podcasting more valuable, maybe we'll see a way for Apple to open up reporting of podcasts to advertisers.
Yeah,
I don't know.
Yeah, two things I want to mention. One, just mention real quick. I feel like we haven't quite sharply pointed out yet. The other dynamic that's really interesting in this industry is Apple. Apple like created this medium, or it was created around Apple.
Yeah,
they're still the dominant player, but they don't care about it at all.
It's funny. They sort of inherited it too. People were creating podcasts and sending them around ad hoc. And they were people were putting them on their iPods, and then finally Apple put a podcast section of the iTunes Music Store, which was just a directory and not a hosting service, for people to do this. And it's so funny that it's still even called podcasting, right? Like nobody has an iPod anymore, and Apple's just like accidentally had this nascent, huge opportunity unfold that they're really not taking advantage of, because it's really not an Apple type business.
Yeah.
Apple classically sells hardware and makes a profit on that hardware, and then has software and services to differentiate that experience. And that doesn't sound like what this is at all. But in this new kind of shifting Apple, maybe we'll see this, but my bet would still be on Apple letting it
doubtful.
exist.
No, and it also, I want to bring up one thing that I've thought about, it's before and in preparing for this show is like, I bet a lot of listeners are saying, well, hey, I mean, like what you guys are talking about already exists. It's called SoundCloud. And like, that's true to a certain extent, but I think SoundCloud and Apple both, like, they're very focused on music. I actually just right before we started recording the show, went through the, for some reason, my old SoundCloud account got deleted or something, and I went through the onboarding process.
It's Twitter's investment.
and through the onboarding process, like, it's super clear that SoundCloud is about music and that they're pushing people to music, not to podcasting. And same with Apple. They bought Beats. Maybe we'll cover that in a future show. And redid Apple Music. They're investing a lot in that. But nobody is really doing this. I think if you're going to build a really great client and consumer experience, like, it has to be about podcasts.
Yeah. Yep, agreed.
Second thing I wanted to mention real quick, Ben, this is a great example since you were talking about PSL. Like, I'm curious, I bet a lot of our listeners are curious, like, what's your process at PSL? Like, how did you guys, when you were diving into podcasts, like, what did you do to validate the market? Like, how did you look at this?
Yeah, so a lot of the times we start with a space that we think is interesting, and that's what we did here. And I really, I'm kind of the guy that buys all of our ads on social and search. And in sort of knowing exactly how that world works, it was kind of like blindly obvious to me, like, wait a minute, if I want to buy ads on a podcast, I have to do what? Like, manually get in touch with someone at mid-roll, and there's a minimum
or at the
spend.
Podcast directly.
Yeah, it's a completely immature market, and so we started pushing on that opportunity and trying to figure out, okay, what would it look like if we actually pursued this? So we do two things. We do kind of a top down and a bottom up. And from a top down, we look at what is the market today and what market forces do we think will make, what does it look like in 5 or 10 years? And obviously that's a guess, but we try and make that an educated guess. And we look at things like, in this, Apple could be either a big risk or potentially make this a lot easier. And that it would be all about timing. So we look at sort of that top down of, okay, how much money could this business really make? What's a TAM there? And then we do a bottom up. And I think that if we were a VC firm, we would kind of just do the top down. And if I was an entrepreneur, we would just do the bottom up. But since we're sort of both, that the kind of startup studio is responsible for both sides of the house in the early stages, deciding whether to go after the opportunity and actually doing some of the building. Once it kind of passes that sniff test of this could be a big business, which this one didn't, then we start really validating, can we acquire customers for significantly less than the lifetime customer value, building as lightweight of stuff as we could. And we really couldn't think of a good way to lightweight test this. Because again, you'd have to be the host, the analytics provider, ship the client, get client adoption. It's a years long process. And it could be an interesting business, just not one that we could do in sort of a short early validation time frame.
Which again kind of brings us back to this dilemma, and we'll see what happens with this set of acquisitions from Scripps, but this dilemma that the industry's in, where like it's kind of hard to just start a company to fix this, like to just start Facebook, or just start Instagram.
Right.
You have to do a lot more heavy lifting than they did up front, and you have to contend with these players like Apple that are hugely dominant in the industry, but a really complex set of motivations.
Right. You would have to have a lot of confidence there to make a big investment in this, that Apple wasn't going to flip some switch, because it seems like while it's not in their wheelhouse, huge risk to your business.
Yeah. At the same time, like there is, like, let's be clear, like as a VC, I believe, and you probably believe too, Ben, like the numbers don't lie. Like there's a massive opportunity here.
Yeah, something will happen in podcasting. It's not totally clear how it'll shake out. And our big question in grading this one is, do we think it's going to be these guys?
Yeah. Let's move on to tech themes and cover that. So I feel like we were dancing around this a little bit in talking about how the kind of the distribution of the audience and listeners is across the industry and different podcasts. My tech theme is the power law. And we see this in so many areas of tech, whether it's the App Store and that the top, 10 apps are responsible for whatever, X 70% or whatever of downloads, and it's the same thing here in the podcasting industry. So Ben, you had some stats on this. I think, was it that the top 10 podcasts are responsible for 40% of listeners in the entire industry?
It's the top 10 publishers, because
Top 10 publishers,
those top
yep.
10 publishers, NPR, This American Life, those sorts, WKYC, I believe, or WNYC. I think WKYC is Cleveland. WNYC, they have a big portfolio of podcasts, and they're sort of just the parent publisher. But yeah, the top 10 are responsible for 40%.
So, again, here's another, puzzle you have to unlock to win this industry is you need those top 10 publishers to be on your platform, because they represent, by far, or the top 100 publishers, they represent by far the majority of the market.
Yeah. Yeah. My theme is it's really hard to compete with the platform defaults. And, Apple ships a podcast app. Even before that, they bundled podcasts into iTunes, I believe it's iTunes on the phone. And, there's that gets someone 90% of the way there. And are they actually going to go the extra mile and go look for a different podcast app? And are they going to look for yours? And is yours differentiated enough? And, I think premium content might be the way to do it. But, businesses have won sometimes even illegally over the years because they were able to bundle with the platform. I mean, look at how IE achieved dominance on Windows being shipped with the platform is a very clear way to win. And actually, that's in the mobile world pre-iPhone. It was a really difficult to install those Java apps on your flip phone. And the way that those companies used to actually get their games and apps distributed was bundling, because if it's on the platform, it's going to get used.
And it's interesting. I'm thinking about the blogging space, and Google acquired Blogger. And you could argue that that's an example of the platform, Google owning Blogger, having an unfair distribution of the distribution channel, owning the platform. But Blogger never had the kind of market share that iTunes does, that Apple does with podcasting.
Yeah, it's true.
All right.
You want to grade it?
Should we bring this one home?
Yeah, so I think we should grade them separately. We'll look at Midroll and then Stitcher. At least that's how I want to break mine down.
I like that.
Midroll, while it is a better company, they're really taking a flyer on spending $50 million on that thing. Their revenues right now are, I think, like $1.5 to $2 million a year, and you really got to believe that there's going to be like a big change in the way that you can stick these businesses together to make that change meaningfully. And were I a betting man, I'd bet against them. So I'm going to...
On the other hand, though, in defense of Midroll, they do have, they are the advertising network for some of the biggest podcasts, which, as we were saying, was one of the keys to unlocking this.
Sure. I still don't know if it's 50 million. I don't know. This is, to me, a old media company that has money lying around, sees their cash pile shrinking, and is concerned about the future and
sees the opportunity in podcasts.
Sees the opportunity, but $50 million for something that makes $2 million a year.
How much did Facebook acquire Push Pop Press for? We don't know, but a lot less than that.
Yeah. Midroll's a D for me. Of the two companies, Midroll is definitely my favorite, but God, that's a high price tag. Stitcher, could they have bought anything else? I mean, if there's another podcast client out there, I guess Stitcher already has this ad pipeline built in that they wouldn't have to sort of do themselves. But to me, just pointing Midroll's ad sales at Stitcher, I have more faith in that as sort of a small business than I do of them executing the large opportunity of creating the top to bottom ecosystem successfully. So I'd say, I'd go a B on the Stitcher acquisition, just because they've already got Midroll and they can point those ads into Stitcher, and I'm sure make some money out of it and get their $4.5 million out. But I don't think they're going to pull this big shebang off.
The whole rodeo. I think I'm with you. Looking at them separately, I mean, one of the things with mid-roll, I'm not going to be as harsh as you. It really, even though the company was founded in 2010, like mid-roll only started 2 years ago. So, yes, like that was a very healthy multiple. Whatever their revenue was, like it was a healthy multiple that they paid for it. But I'm sure it's growing very quickly. And if they can start to get some of the big publishers and represent them, maybe there's more to it. I'm not incredibly bullish, but I'd give it maybe a C plus B minus. Now, again, the real issue is TAM, right? Like the whole key to this is you have to unlock the TAM, the total addressable market, and you have to do that through an integrated platform, which brings us to Stitcher, right? And we have been hating on Stitcher in this with probably with good cause in this episode. But again, like what you were just saying, Ben, I think is interesting. Like who else were they going to buy? Right? Like what were they going to do? They knew they had to have a client, and this is Scripps that we're talking about, and Midroll, while great company and a podcasting company, it's not a tech company. It's an ad network. And it's like a low tech ad network, like spoken word, this is a people business, not a tech business. So they didn't have anybody that they could build this internally. And then who are they going to buy? Like they're not going to buy Overcast, which I use and love. It's
great.
Marco Arment. It's great. No way he's going to sell this to anybody, let alone to Scripps.
I wonder how many users
this is what I'm getting to.
has.
Pocket Cast. I don't know. Pocket Cast could have been a potential one, but Stitcher, for all of its problems, and we don't know how engaged these users are, but they had 8 million registered users. Now, I bet a lot of those were lapsed users. But if you do the math, they paid $4.5 million for 8 million registered users. So they paid just over 50 cents per registered user.
Yeah.
If big if here, they can magically hire some great people to come in and actually build a really good user experience here, like that's fairly cheap for like a pretty big head start. Mm-hmm. Again, I don't think they're going to pull this off, so I'd give that a B. It's not terrible. They didn't spend much money on Stitcher, but I'm handicapping the odds of this success at low. But again, if they pull it off, right, they're going to look brilliant, right? Like if they can pull it off, I don't think they will. They will have spent $54.5 million to win this categgory. I don't think they're going to pull it off. Yeah.
Hey, I also just figured out in looking at Crunchbase to see if Shifty Jelly, the awesomely named parent company behind Pocket Casts, if they'd raised any money, and according to Crunchbase, they haven't, but they are an Australian-based company. So that explains our
cool.
Australian listeners.
Very cool. Right. Shout out down under. Yeah, if you know anything about Pocket Casts, hit us up in the Slack community or by email. We'd love to chat about it. Okay, should we move on to follow-ups?
I think it's time.
All right, 3 quick but super interesting follow-ups this week. First, Twitch, going way back to one of our earlier episodes. We talked a lot in the episode about the massive volume of transactions that are going through the Twitch platform in tipping, which for those that are unfamiliar with tipping or did not listen to the episode, go back and listen to it. I think it was one of our best early episodes. It's raw, but it was good. So tipping is very raw. It's this amazing phenomenon on Twitch where people will just give other people money. So like if you're streaming on Twitch and for a variety of reasons, but your audience will just give you money. It's called tipping. And when Amazon acquired Twitch a couple years ago, all of this was just happening off the platform through overlays and screen overlays that broadcasters would use. Could use Bitcoin or PayPal or stuff to do this. They've now brought this onto the platform, and they just launched it with a feature called cheering on Twitch, and it uses a virtual currency called bits. And super interesting. This is going to potentially unlock a massive revenue potential for Twitch, the company that was already happening in the ecosystem. And also want to give a tip of the hat to our Slack community member James K, who brought this to our attention in the Slack group. I had not seen it. So that's 1. 2, follow up to Facebook Instant Articles. Paper, RIP.
Oh man, it was the best iOS app ever. Period. Hands down. Wow. It was so good.
High praise from Ben. Facebook Paper is being shut down, sadly, but the spirit lives on in Instant Articles within the main app. So
Yeah, if you never experienced paper, you have until the end of July to rush out, download it, play with it.
Yeah. So pour one out this weekend for Facebook paper. And then lastly, super interesting. We posted this in the Slack community, the SEC filing for LinkedIn, detailing all of the ins and outs and blow by blow of the acquisition process came out, and it is super interesting. So we'll link to this in the show notes, and it's also in the Slack group. But turns out there were actually 5 parties involved in bidding for LinkedIn. So Microsoft, obviously, and then everybody assumed, and we speculated on the show that Salesforce, it's now come out, Salesforce was heavily involved in the acquisition, but there were 3 others. 2 have been identified as Google and Facebook. The Facebook story is pretty interesting. Apparently, assuming that Facebook is the party that is referred to in the filing, Reid Hoffman had a meeting with the CEO, of the company, of Party D or whoever it was, Mark Zuckerberg, and said, hey, there's actually this acquisition process for LinkedIn going on. Like, would Facebook be interested in? And Zuckerberg was like, no. So that was not a involved process with Facebook. But Google apparently went pretty far down the path. And then so did the mysterious Party C. Nobody knows who Party C is, but they also spent a lot of time looking at LinkedIn. The other interesting thing in this filing is the bidding war. So the first bid that Microsoft put in for LinkedIn was $160 a share. And if folks might remember, the deal got done at $196. And so what happened, and I think that was about $5 billion worth of value, that's the difference there. And so it turned out, Salesforce and Microsoft were bidding against each other, started at 160, deal was on track to happen. Microsoft had won it at 182 per share. The merger agreement was being negotiated, everything was going along. And then Salesforce, or Party A, as it's referred to in the filing, just comes in over the top after having essentially pulled out with a $200 per share bid, kind of out of nowhere. But the bid was not all cash; it was mostly stock, and so that kind of threw a big wrench in the process. The whole deal with Microsoft had to get renegotiated, and ended up getting done at 196 all cash.
Wow. Great move, Salesforce.
Yeah. I hope that Reid Hoffman and Jeff Weiner wrote sent a really nice bottle of wine to Mark Benioff after that.
Kidding. and will now compete against him.
Yes.
Yeah. Should we do the carve out?
Let's do it.
All right, nice. I have a quickie this week. It's funny, we mentioned The Ringer twice already on this podcast, and The Ringer itself has been my carve out the week that it launched. But my carve out this week is one of my favorite writers of all time announced this week that he will be starting at The Ringer, and that is Mark Titus.
Cool.
Mark is a fellow Ohio State alum who was known, or still is known, it's his Twitter handle, as Club Trillion. And it's the most awesome name of all time because Mark would ride the bench and would get put in for 1 minute per game. So his stat line read 1-0-0-0-0-0-0-0. And so he started this blog called Club Trillion while he was at Ohio State with the tagline "Views from the End of the Bench," and he became this phenomenal sports writing personality. And it's just hilarious to follow on Twitter. And he wrote for Grantland actually when Bill Simmons was there. So really excited to see Mark's writing come back to life at The Ringer.
That's awesome. I love that. Was he there when you were there?
He was, yeah. I'd get to watch his few seconds a game when they'd throw him in.
That's awesome. My carve out for the week is actually a concept, a management tool, self-management or of your teams that probably a lot of you are familiar with, called OKRs, objectives and key results. And I bring it up because it's we just passed the midway point in the year, so I was doing my my mid-year sort of self-review and check-in. I've been using OKRs for a couple of years. They're really great. So the idea, there's a cool history behind it. Google uses OKRs, and they were introduced to Google when they were still a tiny startup by John Doerr from Kleiner Perkins, who was on their board. And so there's we'll link to it in the show notes. Rick Clow, who's a partner at Google Ventures and had been at Google and YouTube before that, gives a great kind of hour-long kind of overview about how the objective and goal setting process works at Google. It's really good. I just use it myself, but it also is great for teams. And the idea is that you set a small finite number of objectives for yourself in any period. And an objective is a high level thing. Like, so one of mine is, help my portfolio companies. And then you set KRs or key results under each objective, and the key results have to be SMART. So specific, measurable, actionable, realistic, and time bounded. I think that's it. Anyway, but so one I have is spend at least 15 hours per quarter face to face with each founder of each portfolio company I work with. So it has to be super clear. Did you hit this? Yes or no at the end of the quarter. Anyway, it's a great system. The concept is you should really stretch yourself and achieve half or less of your key results. But anyway, shout out to OKRs.
Awesome.
All right, listeners, we have a longtime favorite acquired company to tell you about, Modern Treasury. Modern Treasury is the software platform that turns money movement operations into code.
Yeah, for years now, services like Stripe, Adyen, and Square have enabled developers to accept credit card payments in apps. But that's only the tip of the iceberg of what a business needs to fully handle the movement of money in and out of their company. Those payment actions from Stripe and Adyen, et cetera, flowed through to ledger systems and then reconciliations, compliance verifications, and that's before any cash actually moves between institutions, which of course involves banking operations.
Yes, their APIs, of course, work with Plaid, Stripe, Intuit, etc., but also with their incredible banking partner network with over 30 banks, meaning that for the first time, you literally can turn your banking operations at any of those institutions into software. This means faster payments, easy adoptions of new payment rails when they come out, like FedNow. It means automatic reconciliation and real-time financial data. This lets you move money at the speed of software, which, as we now know after the first half of 2023, being able to move money fast is very important.
Yes, we love Modern Treasury so much. The founders and really the whole team have become close friends of Ben and mine, really back to when they first got started. And this is a very cool full circle moment that just happened. We just emceed their first big conference here in San Francisco, Transfer, which happened at the beginning of June.
Yes, if your business involves money movement, be it a marketplace, fintech platform, real estate, lending, investing, or anyone who reconciles or moves money, go on over to moderntreasury.com/acquired and make sure that when you get in touch, you tell them that Ben and David sent you.
Well, that about does it. If you aren't currently subscribed and would like to hear more, you can subscribe from your favorite podcast client. And if you feel so inclined, we'd love a review on iTunes or to tell your friends on Twitter or Facebook too. Thanks so much for joining us.
Till next time.
Till next time.
Who got the truth? Is it you? Is it you? Is it you? Who got the truth now?